Hey guys, Zoeb here from OneGlanceTrader.com and welcome to part 2 of my very own Forex Scalping strategy course. Now, if you're just tuning in, I strongly recommend that you click the link in the top right hand corner or link in the description, which will take you to the playlist so you can watch the whole course right from the beginning to really take benefit of the strategy that I'm outlining here. Now, in the last video, I went through the course outline, which goes through each of the parts in a very high level detail in terms of what each part covers. And just so you guys remember that there are 5 parts to this overall course. Now in this video I go through the 2 main key concepts that are fundamental parts of this overall strategy. So let's get to it. Now, the first concept is an indicator called the relative strength index. Now, the relative strength index is determined by price and is an oscillator with ranges between 0 and 100. So you'll see over here on the right hand side, we've obviously got the price chart at the top, and then underneath we've got the RSI indicator. And what I mean by is derived by price is generally most of the time is that whatever the price does, so does the oscillator. So in this case, the RSI. So if I take this concept over here for a second, so that bit is that bit there, and then price goes down and then up like into a V. So price has gone down, it's gone up again, and then price takes a very aggressive sell-off, and as you can see, that correlates into the RSI. Then it goes back up and then back down into an upside down V, which again happens over here, and then price then takes off into the long direction, which you can see there. So you can see that the RSI mimics price, which is the whole concept of an oscillator. Now, traditionally is what the RSI looks at, hence the name. It's really a strength of the actual stock, pair, commodity, whatever it is that you're looking for. And when the RSI is above 70, so again this line over here, you can see in this red circle here where price is above 70, it is considered that the RSI is overbought and it's overextended to the long side. And as you can see over here, price here is quite at a high, and then what happens is that price then pulls back and retraces slightly. And then the opposite is true on the oversold section. So when the RSI is under 30, as you can see by this green circle over here, it is considered that the price is overextended to the downside. And generally what tends to happen is that when price gets into these oversold conditions, that price will either reverse or pull back to the long side. And that's very important to know. So as I mentioned, this last bullet point over here is that price tends to pull back or reverse when it gets into these kind of overbought, oversold areas. So what can we do as a trader knowing that type of information? So we know that when price is in these type of areas, that majority of the time, not all the time, but majority of the time, price tends to either pull back slightly or reverse in the opposite direction. And that's the first concept of this overall scalping strategy that I'm outlining to you inside this course. So again, if that doesn't make sense to you right now, again, we'll go through it in the rest of the course as well. But just so you know, is that the RSI, what we're looking for in the RSI is when the RSI is at overbought and oversold levels, so at, and I'm doing air quotes now, in extreme conditions. So that's the first concept that I want you guys to really understand and kind of take away from this slide over here. And again, we'll get back to it, but hopefully that's starting to make a bit of sense. The next concept is the concept of regular divergence. So as I mentioned earlier, is that oscillators such as the RSI, there's others like the MACD, the stochastics, hopefully some of these names are kind of familiar to you. They're all, again, calculated using price and therefore should mimic the movement. So as I kind of went through before, as you can see, whatever price does, the RSI tends to do the same, or the MACD, the stochastics. And again, you don't need to understand all of them. All you just need to understand is that oscillator indicators track and mimic the movement of price because their calculation is diverged from price. So that's what I'm getting to through this bullet point over here. However, there are times where the price and the oscillator disagree, and this is known as divergence. And again, I'm going to go through some examples of this inside a second, so it's more visually, so you guys can really visualize this kind of concept. So there's two types of divergences. So there's regular divergence, which means that if you see regular divergence, there's a strong indication, again, nothing's ever 100% true or accurate, is that a trend could potentially pull back or reverse, or hidden divergence where it's a trend continuation. So price is going to continue in the movement of the direction that price is currently traveling at. So in this kind of scalping strategy that I'm talking about, we're only really going to be looking at regular divergence. So let's go into some visual kind of aids here to really help us understand what I'm talking about. So similar to the price chart that I showed in the previous slide, at the top here you've got a picture of price, and underneath you've got a picture of the oscillator. So again, this could be the RSI, MACD, stochastic, whatever it needs to be. You can, I talk about one in this course, which I'll go on to inside the next next part. But you don't have to use the one that I'm using. You can use any one that you want. So what we're looking at here is generally, as you can see here, is as price goes down, the oscillator goes down. As price goes up, the oscillator goes up. As price goes down, the oscillator goes down. As price goes up, price goes up, the oscillator goes up. Then as price goes down, it forms a lower low, but the oscillator doesn't make another lower low. The oscillator doesn't go over here. It makes a higher low. So when you see this kind of formation occur, there's a strong indication that price will either reverse or pull back in the bullish direction. And this is what's known as regular bullish divergence, where price is making a lower low, but the oscillator is making a higher low. So again, this might be a bit difficult to comprehend at this point, but it will become clearer. Again, we'll go through a few examples inside this course. So that's regular bullish divergence. Now we're going to look at an example of regular bearish divergence. So again, if we look at here, price goes up, the oscillator goes up. Price pulls back slightly, the oscillator pulls back. Price again goes up, the oscillator goes up. Price then pulls back, the oscillator pulls back. Price then goes up to make a higher high, so the continuation of this long trend. But the oscillator makes a lower high. It doesn't make the high up here where it should do, because it should, mimic whatever price is doing. So again, this is giving us an indication, an early warning system, whatever you want to call it, that potentially the steam inside this uptrend, similar to the steam in this downtrend, is coming to an end. So therefore, there is a high probability that price at some point, doesn't have to happen straight away, could continue to go up or go sideways a little bit, that price will reverse into a downward momentum. And that is what's called regular bearish divergence. So let's have a look very quickly at some actual price charts of this actually taking place. So let's have a look over here where you can see regular bullish divergence example. So again, we're looking for price to make lower lows and for the oscillator, for price to make lower lows and for the oscillator to make higher lows. So now if we look at this price chart, and we're going to just look at these 2 points over here. So price goes down and the oscillator goes down. Price then pulls back. Oscillator pulls back. Price then goes down to make a lower low. But then the oscillator pulls back down again, but it doesn't get to the lower low. it creates a higher low, creating a regular bullish divergence. And as you can see, what happens is that price then in this instance reverses into an uptrend, and again the oscillator then follows price again as normal. So is these type of examples of what we're trying to look for inside a bullish settings, is when price is making a downtrend. We're looking to see when is that exhaustion of that downtrend going to end, so we can then capitalize on a potential scalp trade to get in inside a long position. So hopefully that gives you a more visual representation of regular bullish divergence. Now let's take an example of regular bearish divergence. So again, similar concept here, that you can see that the price and the oscillator are mimicking each other until we get to this section over here. So if we get to this high over here, price then makes a retracement, and again so does the oscillator, and then price then pushes up to go make a higher high, but the oscillator fails to make a higher high where the peak is around the same or just underneath the previous high, creating a lower high. And again, as you can see here, what happens is that price then in this instance sells off and then creates a downtrend. So again, I really hope that kind of makes sense in terms of you've got regular bullish divergence and then you've also got regular bearish divergence. So I really hope now that you guys can start to see that of what's happening here in terms of this framework of this strategy. So we've got two situations, firstly with the RSI in overbought or oversold conditions. When those kind of frameworks occur, that there's a high probability that price will either reverse as a pullback or actually reverse into a new trend in the opposite direction. Now, counter to that, you've got regular divergence, which either can be bullish or bearish. And again, those examples, as I'm showing on the screen now, again show you times where price is, at point of exhaustion, where there could be a pullback within the main trend, or that main trend could be over into a reversal. So hopefully now you're starting to see now what's going to happen inside the next video, which is, putting it all together into an actual strategy with entry rules and all that good stuff. So you should really see the end screen coming up now with the thumbnail for part 3. So click on that and I shall see you on the other side.